Welcome to Season's blog, High Yield Savings Accounts, how they work in 2026 and what's new. Your guide to what high yield savings accounts, HYSAs, actually offer in 2026. U.S. banks currently pay about 0.38% APYs on regular savings accounts, and the global average isn't drastically any better. The best high yield savings accounts, HYSA, however, pay around 4 to 5% on the same dollars, that is, roughly 11 times. That's why opening a HYSA is still one of the highest leverage money moves a saver can make. But it's only half the story in 2026, given two main ongoing developments. Bank rates have been drifting downwards while the Fed's rate sits almost still. It tells you something about who actually sets your rate. And meanwhile, a new category of instruments has emerged, where the APYs are technically independent of the Fed's policy or arbitrary control. In this guide, we cover both aspects, highlighting where HYSA's yield comes from, what FDIC insurance really protects, whether 4.20% survives tax and inflation, and how an on-chain savings account works to simultaneously preserve and grow your wealth. Key takeaways. High-yield savings accounts, HYSAs, are deposit accounts that offer substantially higher interest than regular savings accounts. Competition, however, is why the best HYSAs pay around 4 to 5% in the US, while the national savings average hovers around 0.38%. Not financial innovation. Banks pool your deposits to fund their earning assets, which makes your APY the price they pay for funding, capped by what the same money would cost them wholesale. Advertised rates are promises, not commitments. HYSA rates slipped through June and July 2026, while the Fed's policy rate remained roughly constant, because a bank holding enough deposits can simply pay less for more. A 4.20% APY clears June's 3.5% CPI by roughly 0.7% before tax, then lands at minus 0.3% for the 24% federal tax bracket and minus 0.9% for the 37% before state tax. Onchain HYS. A's remove the core constraint since your own capital doesn't fund your yield. Seasons Yield 3.0 mechanism routes. Network transaction fees back to node owners in Bitcoin, tokenized gold, and yield-bearing dollars twice weekly at a running approximately 12.58% APY as of round number 68, roughly 3 times what traditional HYSAs pay. How does a high-yield savings account work? A high-yield savings account is a deposit account that pays a more competitive yield than a regular savings account. You open one, move money into it, and the balance earns interest at the bank's published APY. The FDIC insures your deposit up to $250,000, and when you want to take your money out, you need an ACH transfer and 1 to 3 business days. Nothing exotic is happening, though. HYSA rates are higher for rather mundane reasons. HYSAs are typically offered by digital banks that only have an online presence. No physical branches, tellers, or paper statements, and very little real estate. This significantly reduces the bank's overhead costs, a portion of which can be transferred to account holders. Moreover, these digital banks operate in a fiercely competitive landscape, which compels them to direct a bigger share of their profits to users than behemoths like JPM or BOA. Competition is, in fact, the biggest reason HYSAs offer decent rates, and it's not necessarily due to any financial innovation. Where the yield comes from and who funds it. While competition determines the rates banks offer on HYSAs, net interest margin, NIM, sets the ceiling on these rates. It's the spread between what a bank earns across its assets and what it pays across its liabilities. And according to FDIC data, the industry average NIM was 3.31% by the end of Q1 2026, down 8 basis points, QOQ, as asset yields fell faster than funding costs. Banks, however, don't directly lend out the money you put in your HYSA, or for that matter, any savings account. They typically pool the deposited capital and use it to fund their existing assets or meet their liquidity requirements. It's the cheapest and stickiest way for banks to get funding, especially compared to wholesale borrowing through Federal Home Loan Bank, advances brokered deposits, or the interbank market, all of which are priced off the policy rate. So any bank pays you, the depositor, roughly up to the cost of sourcing the same money as funding from other sources, and not much more. Because banks essentially price the APY they offer against their marginal cost of funds. And against that backdrop, the fact that bank rates slipped between June and July 2026, while the policy rate hasn't moved, signals that banks holding sufficient deposits can simply lower the price they are willing to pay for more of them. That's also why it's best to treat advertised HYSA rates as promises rather than commitments. HYSA rates in 2026. Three numbers frame the market as of late July 2026. 0.38% APY is the national average savings rate, per the FDIC's national rates and rate caps. Large branch banks drag this down, which is exactly why the average is not a target. Around 4.20% APY is where the leading HYSAs cite. Forbright Bank runs a promotional 4.15% with a $1,000 minimum as of July 28, 2026, but the names at the top rotate constantly. 3.50 to 3.75% is the federal funds target, serving as the anchor for both numbers above. Compare that to products like money market funds, MMFs, and 12-month CDs, which currently offer 0.65% and 1.68%, respectively, on average. That said, here's one rule of thumb to follow when evaluating HYSAs. If a bank is paying significantly higher rates than its competitors or market leaders, the figure is either promotional or based on thinner, often unsustainable balance sheets. There's nothing essentially wrong with either, but they're worth mulling over for a few extra minutes. Does a high-yield savings account beat inflation? Here's the question the rate comparison sites never quite answer, and it decides whether your account is building wealth or just slowing the bleed. Start with the headline. The CPI rose 3.5% over the 12 months to June 2026, per the Bureau of Labor Statistics, with core inflation at 2.6%. Against 4.20%, that is a real return of about 0.7%. Positive, but thin. Now apply tax, because HYSA interest is ordinary income. For those in the 12% federal bracket, HYSAs deliver roughly plus 0.2% net return. For the 24% and 37% brackets, though, real post-tax yields are minus 0.3% and minus 0.9%, respectively. State income tax, where you owe it, drags each of these numbers lower still. So, HYSAs advertising 4.20% are quietly depleting purchasing power for a large share of their holders. The principal is insured, your money is liquid, and they beat the 0.38% national savings average by a mile. But better than a checking account and grows your wealth are two different claims, and the industry is happy to blur the boundary. For an extensive discussion on how cash-like instruments perform against inflation and currency dilution, read Always Liquid, Always Earning. FDIC insurance, coverage limits, and joint accounts. Besides their advertised rates, the FDIC insurance is one of the biggest reasons users choose traditional HYSAs over alternatives. Thus, before discussing such alternatives, it's worth taking a closer look at this insurance, its benefits, and limitations. FDIC insures you against your bank failing, with a coverage of $250,000 per depositor, per insured bank, per ownership category. Joint accounts are covered up to $500,000 because each owner gets their own limit. Meanwhile, retirement deposits are allotted a separate category with a separate $250,000 coverage. Notably, $250,000 isn't merely an academic threshold. as the events of 2023 proved. The Silicon Valley Bank held $175 billion in deposits at the time of its collapse, and over 85% of its deposits sat above the FDIC limit. Regulators used a one-off systemic risk exception to make depositors whole, but the FDIC said plainly that this was an exception and not a new policy, and the next failure would default back to the standard limit. This story is as reassuring as it's frightening for the average saver. Nevertheless, the general safeguard is to stay under the per-bank limit so your principal survives the bank. And on top of that, it's important to know what FDIC doesn't insure. MMFs, for example, are categorized as mutual funds, not deposits, and don't fall under the FDIC's purview. The future: on-chain high-yield savings accounts. In 2026, high-yield savings is no longer only a bank product, as emerging on-chain savings instruments are generating yield through entirely novel mechanisms. Simply holding a certain amount of C's, Season's official work token, makes you a node owner and lets you use your non-custodial Solana wallet like a high-yield savings account, unlocking a constant liquid cash flow. You don't need to deposit or lock up your funds to access this flow. Hold, and that's all. Thanks to the unique architecture of Season's Yield 3.0 mechanism, the capital held in your wallet doesn't fund the APYs you earn as a node owner. Currently, the Transactional Transfer Tax, TTT module, collects a 10% fee on every C's transaction, which is circulated back as yield. In the future, two other modules, SSYM and YAV, will complement TTT to further amplify the APY, at which you earn yield on Seasons. What's more, Yield 3.0 unlocks infinite and permanent DCA into Bitcoin, gold, and yield-bearing stablecoins, which are the assets in which yield is delivered directly to your wallet, twice weekly, round after round. As of round number 68, on July 29, 2026, Seasons has delivered $250,639 plus in total yield at a running APY of approximately 12.58%, about 3 times more than traditional HYSAs. Node owners have received nearly 9 ounces of tokenized gold, 0.5 plus wrapped Bitcoin, and over $50,000 in yield-bearing on-chain dollars that auto-compound daily, and counting. For a complete breakdown of the value Seasons generated and distributed in Q2 2026, read our in-depth Q2 recap. And for the latest, round-by-round updates on yield payouts, follow our X/Twitter and other official channels. At the time of writing, you need to hold at least 10,000 C's to access high-yield on-chain savings and digital native liquid cash flow with Yield 3.0. But soon, following the Node Software v2 upgrade, the mechanism will get a second entry path, making it even more accessible. Wallets holding 1,000 to 9,999 C's will be recognized as builder nodes on the network, and they will also earn yield while building their way up to the full Director Nodes tier that reaps the system's maximum benefits. Check out Builder Nodes Are Coming to Seasons for a deeper overview of what's coming and how it will significantly catalyze the expansion of Yield 3.0. Which HYSA is best for you in 2026? Overall, high-yield savings accounts are among the best instruments available to users today. But as the inflation and tax-adjusted numbers show, the traditional variants aren't as lucrative as they are advertised to be. That's the gap on-chain HYSA products like Seasons Bridge, so you can grow your wealth while retaining full control. Here, you don't fund your own APYs. Instead, you let genuine economic activity do its job of creating value. The yield you earn with Seasons actually supports your life and lifestyle, rather than competing with it, as we elaborated in our blog on accessing infinite and permanent DCA with Yield 3.0. And that, by the way, becomes a key consideration when you're choosing the best HYSA instrument for your needs. When the question is what's best for you, there's no answer except the one that actually grows your wealth and complements your journey towards financial freedom. That's what matters. Frequently asked questions, FAQs. What is the average APY on a high-yield savings account in 2026? The FDIC put the national average savings rate at 0.38% APY as of June 2026. That average includes every bank, most of which pay close to nothing. Top online accounts pay around 4.20% APY as of late July 2026, roughly 11 times the average. Rates are variable and have drifted slightly downward through the summer. Do high-yield savings accounts beat inflation? Barely, and often not after tax. A 4.20% APY against June 2026's 3.5% CP. iPrint is a real return of about 0.7% before tax. A saver in the 24% federal bracket nets roughly 3.19%, which lands just below inflation. Are high-yield savings accounts safe? A HYSA, at an FDIC, insured bank is insured up to $250,000 per depositor, per bank, per ownership category. Your principal is protected against the bank failing. The risks that matter day to day are the rate changing and inflation eroding what that rate buys. Can the bank lower my HYSA rate? Yes. The rate is variable and can change at any time, with or without notice, depending on your account agreement. Most online banks adjust within weeks of a Fed move, and they also adjust when the Fed does nothing, which is exactly what happened across the summer of 2026. Is there a crypto version of a high-yield savings account? Yes. An Onchain savings account is a self-custody wallet that receives yield distributions from a protocol instead of interest from a bank. The rate driver is protocol fees and genuine economic activity rather than ad hoc policy. How does Season's on-chain savings work? Hold 10,000 or more Cs in any Solana wallet, and that wallet receives distributions of wrapped Bitcoin, tokenized gold, and a yield-bearing stablecoin twice weekly, on Wednesdays and Sundays. There is no staking, no deposit, no claim step, and no withdrawal queue. As of round number 68, on July 29, 2026, Seasons has distributed $250,639 plus across 340 node owners.